Adrian Hill from Superior Accounting Group, and today I'm going to be discussing maximising your interest deductions. As we all know, when we borrow money to buy assets such as businesses or investment properties, you're borrowing a lot of money, so we want to make sure that if we're going to claim the interest on it, we want to maximise that claim each and every year, and it's important to understand that. First thing you need to understand in relation to interest is, if you borrow to buy a property, say it was $500,000, and you borrow $400,000 from the bank, and the being 80%, and the other $100,000 you borrow against your home. What you really need to understand is it's not what the property is secured against that dictates the purpose of the borrowing. So what I mean by that is, the $400,000 loan is secured against the property that's in an income producing property. So hence the interest on that loan is deductible. But the $100,000 that's secured against your home, even though that's a private residence, because that loan is used to buy an asset that's income producing, the interest on the $100,000 loan is also tax deductible. So therefore, it's not the security, it's the purpose of the money that dictates the tax deductibility. Another type of loan product I want to cover today is a line of credit. A line of credit is often used in finances when you're buying rental properties / businesses. A line of credit is like a big credit card because they set you up a loan with a predetermined credit limit, and you don't have to fully draw that at settlement, and you only pay interest on whatever balance is on that line of credit. But what you really need to be careful of with a line of credit is if you put money into the line of credit that's currently a tax deductible loan, and then you borrow back to buy a boat or something that's not tax deductible, you've now converted a fully deductible line of credit to a partly deductible line of credit just by that one simple transaction. So you really need to seek careful advice and understanding before you start moving money around with loans. And the last thing I wanted to cover, and a product I love the most, is an offset account. What an offset account is, you actually have a loan to the side and a check account to the side. Now, instead of putting your money into the loan and paying the loan down, what you do is you put the money into the check account. But what the bank does is, when they're applying your interest, they offset what's in the check account against what's in the loan and only charge you interest on the difference. But what benefit you get from that is because you actually haven't paid the loan down, you can pull money out of that check account and use it for private purposes, and it doesn't affect the tax deductibility of the loan to the other side. Now, not all banks have offset accounts, and offset accounts are not the same as line of credits or redraw facilities. So if you want to set up a loan, especially where it's your home or something that's you're potentially going to be moving money around, my suggestion is to set up an offset account up front, up at the start, which gives you the maximum efficiency and the ability to be flexible and maximum, so that you make sure you continue your ability to claim as much as you can for as long as you can. Now, if you have any further questions in relation to interest and tax deductibility, or you want to seek some advice by us one-on-one about how to maximise interest in your current personal situation, please feel free to contact us.